One of the most common questions that I get asked as a financial planner in Ireland is, how much income will I actually get from my pension? And that is closely followed by, will it be enough? These are big questions, and for many people, it can cause a fair bit of stress. So in this video, I want to give you a clear picture of what's realistic, what's sustainable, and what's possible from different pension pot sizes. We're going to look at 3 example pots, 250,000, 500,000, and €1 million. And I'll walk you through what sort of income each one could reasonably support, assuming that you want your income to last your whole retirement. I'll also explain the factors that influence those numbers, things like inflation, the state pension, investment strategy, and how your withdrawals are timed. And finally, I'll share a few insights as to how you can improve your chances of a successful retirement. All right, before we jump into the numbers, I want to explain some of the key assumptions behind the figures that I'm going to show you. First, we're going to assume retirement starts at age 65 and we'll plan your income right through to age 95. Now, I know that many of you are thinking, I won't make it that far. But remember, the real risk isn't living too short, it's living too long and running out of money. We're not relying on average life expectancy stats or complex mortality curves. We're being conservative and we're planning for longevity. It's better to be safe and make sure that your income lasts. Next, we'll assume your pension stays invested in a balanced portfolio made up of 60% global equities, 40% fixed income. Now that is a typical mix for retirees. It aims for balanced growth with a bit of stability. Historically, this kind of portfolio would have returned about 8% per year. Of course, that is not guaranteed. It's a guide based on long-term market history. Another assumption is 2% inflation. That's the current ECB target at present. We'll also apply a 1% annual fee to cover investment management and financial advice. Another thing that's really important here is that we're going to assume that all the income figures shown are pre-tax. And the final key point is we're not assuming a tax-free lump sum is taken. Instead, we're keeping 100% of the pension fund invested, even the part that could have been taken tax-free. Why? Well, because this helps us assess the true longevity of your pension pot and whether it can realistically support a 30-year retirement. Finally, we'll apply sustainable withdrawal rates. This means drawing in a way that gives you the best shot at lasting without running out of money. Think of this as a benchmark for good planning, not a promise, not a prediction, but a practical framework to guide your decisions with confidence. If you're already thinking, where do I stand in all of this? Well, let's talk. I offer a free consultation call specifically for business owners and high-income professionals in Ireland. We'll look at your current setup and map out a strategy that covers the full spectrum, from investments to pensions to tax, cash flow, risk, and estate planning. If you want a clear path to your goals, just click the link in the description below for a free, no obligation call. So let's begin with a couple with a pension pot of €250,000. That is a realistic figure for many people in Ireland approaching retirement. Now, using financial modeling software, we can see what kind of income this pot alone can support before we bring the state pension into the mix. At age 65, withdrawals start at approximately $13,000 per year. At age 66, this drops slightly to about $11,000, and then by age 70, it rises to $12,800. Then at 71, the drawdown rate increases from 4% to 5%, and the income jumps to $16,475 per year. From that point on, withdrawals increase with inflation, helping to maintain your spending power over time. Now, here's what's important. The pot does not run out. With conservative and sustainable drawdowns, it continues to support a modest level of income into later life. But let's be honest, even with this approach, this income falls well short of what many would consider comfortable. For context, the median disposable income for couples over 65 in Ireland is around €42,000 per year. That is not a luxury lifestyle. It's a basic benchmark for mortgage-free couples that are no longer supporting their children. So while this €250,000 pot does offer some support, the real question is it enough? For most people, probably not. But in the next section, we'll see how factoring in the state pension could shift the outlook significantly. So far, we've looked at how a €250,000 pension pot performs on its own. We saw that it provides about €13,000 per year. It falls well short of what most households would consider a comfortable retirement. Now, let's introduce the most important income source in Ireland, the state pension. Currently, the full contributory state pension pays just over €15,000 per person per year. That's €30,000 per year for a couple, and it's inflation linked. usually begins at age 66, depending on your year of birth. And when we factor that into the plan, something significant happens. Remember, at age 65, you're drawing down about €13,000 per year from your pension. But at age 66, when the state pension kicks in, your total household income jumps to around $42,897. That is a major shift. And notably, it brings you very close to the national median income for retired couples. And just to be clear, these figures are not in today's money. They're adjusted for inflation, meaning they reflect projected future income levels that keep pace with the rising living costs. So what's the key takeaway here? Even if your pension pot alone isn't enough, the state pension combined with a well-managed private pension can deliver a sustainable, realistic retirement income, especially when modeled carefully with inflation and longevity in mind. Let's talk about security. Not just how much income that you may get, but how likely is that income to last? Now, you've probably heard the scary stories before, that the state pension won't exist when I retire, or the government can't afford to maintain it. But here is the reality. The Irish state pension is part of a social contract between the government and the citizens of Ireland. It is extremely unlikely to be scrapped. Now, it is possible that the age of access may continue to increase, but the pension itself is very likely to remain in place. So let's shift the focus to your private pension pot. How secure is that part of your retirement income? This is where financial planners use something called Monte Carlo simulation. Now, it sounds complex, but the idea is really simple. It tests your plan by running thousands of different market scenarios to see how often the money would last you to age 95. So why does this matter? Well, because average returns aren't what you experience in real life. What matters is when those returns happen. A bad run of markets early in retirement could hurt your pension much more than later on. This is called sequence risk, and it's one of the biggest threats to your retirement plan. Monte Carlo modeling helps us account for that risk. So we're not just planning on hope, we're planning for real-world uncertainty, with strategies designed to hold even when the markets don't. So what if your pension pot is much bigger? Let's say you've built up €500,000 or even €1 million in your pot. What could those pots realistically deliver in retirement? So let's start with €500,000. At age 65, you draw down about $26,500 per year from your pension. Then at 66, when the state pension kicks in, total household income jumps to about $57,800. And at age 71, we increase the drawdown from 4% to 5%. This brings your income up to around €73,400 per year. Again, all inflation adjusted. That extra income in later years is valuable, especially as healthcare costs or family support needs may rise. Now let's look at a pot of €1 million. At 65, you're drawing down around $53,000 per year. And at 66, when the state pension is added, your income will increase to $79,600. By 71, with increased drawdowns, your income reaches around €105,000 per year. This gives you a significant freedom to enjoy retirement on your own terms. The takeaway? Yes, pension pot size matters, but what matters just as much is how you withdraw from it and when. With the right strategy and the support of the state pension, you can turn your savings into a reliable income and build a retirement with confidence and control. So we've seen how different pot sizes produce very different outcomes, but here's the next layer. The pot size doesn't just set your income, it also shapes your strategy. Let's start with a smaller pot, say €250,000. In this case, your margin for error is very low. You'll likely need to be more cautious with your investments and lean more on the guaranteed sources like the state pension. Every financial decision matters more, from paying off debt to controlling your spending to avoiding unnecessary risk. Now, if you build up a larger pot, say €500,000 or €1 million, you've got more flexibility. But this also brings more complexity. You'll want to begin to start thinking about tax planning, how to withdraw income in the most efficient way, investment risk, balancing growth with protection, and even inheritance planning, especially with the current capital acquisition thresholds in Ireland. So right now, children can inherit up to €400,000 tax-free, and anything above this is taxed at 33%. So the more wealth you build, the more important it becomes to have a plan, not just for income, but for everything else your wealth touches. The bottom line, more money gives you more options, but it also gives you more decisions to make. And that's why clarity, structure, and advice become even more valuable as your pension pot grows. So by now, you have a much clearer picture of what type of retirement income you can expect from a pension pot of €250,000, €500,000, and €1 million. The challenge for you now is what actions that you can take to move the needle on your retirement funds. First, shorten the time frame. If your plan was to retire, say at 55, that may feel ambitious. Pushing it out to 60 or 65 gives your pot fewer years to cover. This means you can draw down more safely each year. 2, top up your contributions. Even an additional €50 or €100 a month now can add thousands into the future, especially if you've got time on your side. Third, build flexibility into your plan. You don't need to lock yourself into one income level forever. If markets dip, pull back. If they do well, we'll take out a little bit more. That flexibility is key to long-term success. Fourth, don't chase more risk than you need. More equities doesn't always mean better outcomes. It just makes your results more volatile. Manage risk in line with your plan, not your emotions. And fifth, check it regularly. A plan made today won't last 30 years untouched. Review it annually, update your assumptions, and make sure that it still fits your life. And finally, get advice or use the right tools to manage it yourself, because retirement is too important to leave to guesswork. If you're not sure where you stand, whether you're ahead or behind, or you're simply unsure, let's talk. We'll review your entire financial picture from investments, pensions, tax, cash flow, risk, and estate planning. And we'll map out a strategy that fits your goals. Just click the link in the description to book your free, no obligation call. Again, it is completely free. No pressure, just clarity. If you've been wondering, when can I actually retire? Or even, could I retire now? Well, you're not alone, and the answer might be closer than you think. In my next video, could I actually retire sooner than I think? I'll walk you through 7 key questions that I ask my clients to help them figure out if work could become optional. And if you answer yes to most of them, it may be time to stop waiting and start living your life today.